The broadcast is now starting. All attendees are in listen-only mode.
Okay, good morning, everyone. My name is Steve Ferrace. I'm Director of Marketing here for Suburban West Realtors Association, and on behalf of the association, I'd like to welcome you to today's program. It's our 2019 commercial market outlook for the Philadelphia area, presented by CoStar. So before we get into the program, I did want to why is that not working? Okay. I did want to just give you a couple of announcements of upcoming events going on through the commercial chapter. Most of you were in receipt of a flyer today of a program that we're sponsoring that KW Commercial has put together on real estate syndication. That was actually originally scheduled for November 15th, and then the snow came, and unfortunately it got postponed, but we're excited to have it rescheduled for now February 27th. It's going to be at the Philadelphia Country Club, which was originally scheduled for. And the main attraction is the speaker, Gene Trowbridge, who is a CCIM and a national instructor who does a terrific job. And again, we're excited to have him for that program. We are hopeful to get education credit for it. We actually had decisions, I think, being made just this week by the commission on education credits for it. So that's also perhaps on the table as well for this event. There'll be more information that is emailed out about it. But again, if you can make it out on the 27th for the program, and then we have a reception at the end of it as well from 5 to 7. So again, hopefully we'll see you there on February 27th. In addition to that, you also were provided our tech helpline cards. So if you're a member here at Suburban West, that is a free service. It really is a godsend to members who have run into technology issues, whether it's with their computer at home or at the office, or any of your cell phone or any of your electronic devices related to that. And again, whether it's a virus on your computer, having trouble installing a printer, slow computer, again, they can really help you out. They're based out of Florida. They are run by a realtor organization, so they are familiar with technology issues that realtors have. So again, it really is a tremendous service. It's available 6 days a week, Monday through Saturday. And again, on that card is that phone number, so keep that handy. Again, if you run into any issues, whether it's at home or at the office with technology, again, they can certainly help you out with that. Okay, so that said, we want to get started with today's program. We're excited to have CoStar back. They were with us back in August and did a great presentation on the apartment building situation in the Philadelphia area, and looking at kind of how things were going with that. So we're excited to have them back to talk about commercial real estate in general and where they see the data and where 2019 is headed with that. So we're excited to once again welcome Adrian Ponson, who is a market economist covering the greater Philadelphia region for the CoStar Group, who's the leading provider, of course, of commercial real estate market information and research in the U.S. Adrian analyzes thousands of data points CoStar collects every day from rent listings, construction projects, and sales transactions to help Philadelphia area commercial real estate professionals identify key market trends, minimize risk, and maximize returns. So I'm going to welcome up Adrian, and I'm going to hopefully get this computer squared away too. So I'll let you kind of start in, and then we'll get this all squared away here too.
Thanks, everybody.
Sharing. Oh, I know what I need to. Okay, show my screen. There we are. Okay, we're set. Okay, and let me just do this here for you. Over there. And I'm beginning. There we are. You're set.
All right, great. Thank you.
You're welcome.
So before I get into kind of the meat of the presentation, I just want to do a little bit of an intro on CoStar for folks who aren't familiar. Starting with our people. The company consists of almost 2,000 researchers, over 200 field research vehicles traversing the market every day. And now we also have a plane that canvasses the country in a grid pattern, taking photos of properties under construction. So throughout the presentation, in the section headers, you're going to see some of the photography that they took of some Philly projects when they came through a few months ago. When you subscribe to the Philadelphia Marketing CoStar, you get this vast area covering most of southeastern Pennsylvania, Delaware, South Jersey, and within that there's over 80,000 different commercial properties that we track, 70,000 historical sales comps, and just currently right now there's over 6,000 different commercial spaces that are listed as available for lease in there. So, and for each one of these properties that we're tracking, we have the current information and contact info of the true owners of that property, property management contacts, emails, phone numbers, any available space, and the rent, if there's a rent listed with it, and sales comps information, amenities, all kinds of things. And so the kinds of businesses that we serve is really everyone across the board that's involved in commercial real estate. So brokers, appraisers, lenders, etc. These are all the folks who are involved in collecting data for the Philadelphia market in any given day. The property researchers, so they're the ones making sure that any space availability listing that you see on CoStar is updated at least every 30 days. The field researchers, these are the folks who are driving the market every hour of the working day, taking photos of both existing projects and those under construction. And the comps research team, whose their job is just to specifically to just gather as much information on sales transactions as they can. We also have, for CoStar clients, there's unlimited product training at no cost. So Erica Dahl, she's just traveling around the region every day doing trainings for folks. So if I know there are some CoStar subscribers here, so if you're looking to get a training on the product, Erica's the one you would want to talk to. Matt Morgan, the account executive, so he covers sales for the western suburbs of Philadelphia, where we are right now. And me, Adrian, I work for the market analytics team, and my job is to take all of this data that all these researchers are putting into CoStar every day and help clients figure out what it all means for what's going on in the market. In terms of what we're going to cover today, last time when we did the apartment market presentation, we had a lot of interest from folks in talking about the economy, and I think there's probably even more interest now with the recovery getting pretty long, entering its 9th or 10th year, and the stock market gyrating. So folks are paying closer attention to this. So we're going to go in depth on what's happening with the economy, both in the U.S. and in Philly, and what we expect for next year. And then we're just going to dive right into different property types, the apartment market, the office market, and the industrial market. So starting off with the U.S. economy, does anybody want to kind of, I'd like to do this at the beginning of each section, just folks can kind of chime in and talk about what they're seeing going on out there in terms of how the economy is affecting their business or what's going on in the individual property. Anybody have anything to share on what they're seeing out there right now?
Just a question. The Durst organization
Yeah.
has acquired something huge in Philly. What do you think that's going to do to the market?
I don't want to get into a specific sales transaction quite yet that they're involved in. Just I try not to comment too in depth, especially on one that hasn't completely closed. But we'll get into the different property types and everything shortly. So anybody?
Will you be touching on taxes and any of those implications, abatements, things of that nature?
Not in this go around. No. All right. So, and in each one of these sections, when we talk about the economy, talk about the apartment market, the office market, et cetera, we're going to kind of start by talking about how we got here, how the market's doing right now, and where we got to where we are today, and then the themes that are going to drive the market over the next 12 months, right? So, yep. No,
I am a CoStar subscriber, and my name's Peggy. So, are your slides available to me?
Absolutely.
The knowledge center?
Yeah. They will be. I can send them out to you, but there's also a recording of this presentation happening right now, so you'll have the talk track as well with the slides.
Oh, okay, thank you.
Yeah, you're welcome. All right, so in talking about where we are today with the economy, I think you really have to start with the tax cuts that went through about a year ago. So this is looking at the 5 largest previous tax cuts that have been enacted in the U.S. as a percentage of GDP, right? And so you can see this isn't the biggest tax cut that's ever gone through, but it's up there in terms of the top 5. And what's most interesting about it is that if you look at all previous of these 4 major tax cuts, these were all implemented either during a recession or just 1 or 2 years out from a recession, right? So the tax cut that's gone through now is unique in the sense that it's being layered on when we were 8 years into an economic expansion. So it's had big implications for the economy and for leasing, and we'll show how that's rippled down into Philadelphia. And the primary driver of that was the U.S. corporate tax rate being cut almost in half, from about 35% to the low 20% range. So very impactful for businesses. In addition to tax cuts, the government has also increased its spending. So the most recent, we're still waiting on a new budget, but the previous one that was passed increased spending by about $200 billion a year. So on things like military spending and disaster relief. So the government is really injecting a lot of fiscal stimulus into the economy as we head into this new year. The downside of that is that obviously if you cut taxes and you increase spending, you're going to be borrowing more, right? So our debt is increasing faster than it was just 2 years ago. That's the downside. But the positive side of all this, of all of the tax credits and spending injected into the economy is really visible across a lot of different indicators. So this is small business optimism, right? And you can see it's really surged just in the past 2 years and continues to go up. Business investment also rebounded in a big way, and that's important because that's really a driver of the economic cycle overall. So that's turning up. Job openings also were already near all-time highs, and they've just pushed even higher. The one thing that we haven't really seen kick into high gear is job growth, but that's only because unemployment is already so low. It's below 5%. So there are just simply fewer, unencumbered workers left to hire and join the workforce. So hiring has been pretty steady. The positive side of that is that the labor market is really supporting accelerated wage gains, right? So you can see here that for the past 2 or 3 years, we've been supporting 3% wage growth, not just for college-educated folks, but for non-college educated folks as well. And so this is obviously a huge positive because this is the first time in about 10 years that we've seen wage gains on par with what we saw during the previous economic expansion, for example. And that has big implications for apartment rent growth as well. So kind of putting these things all together, there's something called the leading economic index. And what that does is it basically just compiles a number of forward-looking measures of the economy. So things like companies' new orders pipeline, their plans to hire, et cetera. And what you can see is that this has been pretty good at telling you when the economy is about to hit a turning point in the past. So it peaked in 1989, and the 1990s recession didn't start until about a year and a half later. Peaked in 2000, about a year before that recession, and it peaked in early 2006, a year and a half before the recession that followed that. So when we look at what that index is doing today, it still continues to move up, right? So that's a strong indicator that the economy is going to continue growing into this year. We need to first see this thing plateau and start to come down before a recession would be 6 months to a year plus out, and we haven't seen that yet. So we're going into the new year with good momentum. So those are the positives. On the negative side, inflation, with all this growth accelerating, inflation is starting to kick up to about 2%. And with that, the Fed is raising interest rates, right? So short-term rates particularly are on the rise. Yeah.
Coming back on your last slide, talking about general trends going forward, one thing I've been hearing a lot about is China's economy, at the slowest pace in what, a few decades or something like that. I mean, it's still at 6% rate by arguments, but do you see any impacts? And you're also hearing out of Davos a lot of people kind of bearish on the market going forward, whereas what you just said almost points to somewhat contradictory to what I'm hearing out of some of the emerging signals.
Right. Well, one thing to keep in mind is that the U.S. is it's the biggest market in the world, and it's a pretty insular economy in the sense that we're not an export economy. So a slowdown in China, it can hurt exports at the margin, but on the whole, in some ways, it actually makes things a lot easier for us because it lowers energy prices and maybe even lowers the cost of imports. So we have one slide kind of getting at this, but overall, a slowdown in China is, because we aren't export-oriented, it's not necessarily a huge detriment to growth, but it is a sign of slowing in the global economy. Yeah. The good news so far is that households are actually taking the increases in rates that we've seen pretty well in stride, right? So this is looking at delinquency rates of consumer loans, mortgage loans, auto loans, student loans all put together. And what you can see is that there hasn't really been any significant uptick in any kind of delinquencies since the Fed started raising rates, right? So that's a very good thing. On the margin, auto loans have actually been ticking up on their own. That was something that consumers really levered on, a lot of debt for auto loans post-housing crisis when they weren't taking on new mortgages. But in the aggregate, consumers' ability to manage their debt is still strong, and that's good. Many of you are probably very familiar with this. We've also seen, since the interest rates have started to go up, we've seen home sales declining at the national level, right? And one thing that's interesting about that, if you see the dip that occurred in 2013 or 2014, and that orange line, that was the last time that mortgage rates really got in the 4.5% to 5% range. And it happened again in the later half of last year, and you saw sales dip again. So it's kind of an indication that new buyers are pretty sensitive once you get up into that 4.5% to 5% range of mortgage rates. Manufacturing is also slowing. And a big part of this is concerns about trade tariffs, slowing growth in both China and Germany, two of the world's biggest economies, are slowing significantly. And also with energy prices going down, that hurts a lot of manufacturing. We now have the second biggest, or we're now the largest exporter of oil in the world. So that hurts some of the manufacturing activity for their infrastructure. And this is the last thing as we talk about the risks and where we are in the cycle that I think is actually more important than any of these other risks that we talked about. And that is that when you ask consumers how they're feeling right now about the economy, they tend to say they're feeling very good. But when you ask them about their expectations for their future, for the future of the economy, more and more they'll answer that they think where we are right now is about as good as it gets, and that things will slow down going forward, right? And you can see that in this blue line here. What this is measuring is their expectations for the present minus future expectations. So when it dips down to the negative, that's when they think the future is going to be worse than the present, right? And so this isn't necessarily a huge risk factor, but it's just an indication that, households, they don't have fancy economic models where they can try to predict what's going on, but they drive the economy. And if they have the expectations that the economy is really booming now and this is as good as it gets, that leaves them vulnerable if some negative headlines start to come out about the government being shut down for 6 months or employers laying people off, et cetera. That then reinforces the mind state that they already have and makes it easier for them to then pull back on their spending. Yep. Can you tell me what the scale is on the left? It's just the point difference in these two indices. So they track the consumer sentiment based on an index. Yeah. Yep.
So that graph here, if you look at 2010, high data point. Is the consumer saying it can't get any worse than this at that point?
Yeah, exactly. Yep. And this can hang down in this territory for a while. You know, you could see in the 90s and in 2005, 2006, it just stayed low and leveled off. So it's not necessarily a cause of a recession or anything like that, but it just tells you where the average household kind of thinks that we are right now in the cycle. Yep.
What do you think the implication is of the government shutdown? I mean, my anarchist roots are, you know, I'm sympathetic and empathetic, but it can stay shut down as far as I'm concerned.
Right. Right. So while this is the longest one, we have kind of seen this play out a few different times in the past few years. So there was the debt ceiling in 2011 and the fiscal cliff and the government shutdown in 2013, right? And what happens, at least in the past, is that you do see a significant dip in consumer confidence because people are seeing all these headlines and they think that it's going to be bad for the economy. In the past, it never really spread beyond that. You never saw it really dip into job growth or retail spending or anything like that in a significant way. And that's kind of where we are right now. They just reported consumer confidence a week or two ago, and it was at a 2-year low. So people see the headlines, and they think there are more problems out there. But it really remains to be seen how it's going to affect. I mean, yeah, if it drags on for a few more months, then think about it. If you're a large business, you're probably better off just waiting until this stuff resolves itself before you get underway on a big expansion or you start hiring. So it certainly could, but we're in uncharted territory in the sense that this is the longest one yet. But then once it gets resolved, you could easily also just see a.
By the way, I believe the president, the tax cut was by far and away the biggest on record. Not the.
Okay. Yeah. It was definitely the biggest on record in the middle of an economic expansion. That's.
No, I didn't see.
Oh, okay. All right. Yeah. Okay. In terms of, all right, so what does this all mean for Philly? And this is really interesting. So this is where you see the impact of those tax cuts, how that affects large companies in Philadelphia. So this is an index of the top 35 publicly traded companies that are based in Philly, and these are their corporate profits per share. So big companies like Aramark, Amerisource, Virgin, Comcast, FMC. All of their profits more than doubled their previous record high in the year following this tax cut.
Kind of like our cable bills doubled.
Right, exactly. Yeah. So it's really been a windfall for them. And when you look at companies in Philadelphia, their plans to hire. So this is a survey that a third-party staffing company tracks, and it looks at companies planning to hire or to cut staff in the year ahead, right? And you can see that the percentage of companies that want to increase their staff is as high as it's been this entire economic cycle, and the percentage of companies who want to decrease their workforce is near rock bottom as well. So we're running out of people who don't have a job in general. So that should cause hiring to slow going into this year. But the reality is that the top employers in Philly have so much money and so much willingness to hire at the moment that regardless of all these other risks that we talked about during the first part of the presentation, that should carry Philly's economy through with growth, at least through the end of this year. And the question is how strong and how sustainable is that growth going to be? But the economy looks pretty well positioned for 2019. So just some takeaways there. Highly likely that the expansion is going to continue into this coming year. Record corporate profits and healthy wage growth. Those are keeping companies and households happy and hiring and spending. And that's really the important thing when you look at growth. And then on the risk side, trade tensions, rising interest rates, somewhat skeptical consumer expectations. These all leave the economy more vulnerable as the impact of these tax cuts start to fade into history. All right. So now covering the apartment market. I'm sure we have a lot of folks here working in the apartment market right now. Anybody care to chime in, talk about kind of what they're seeing out there in the market and what they expect this year versus what they saw last year?
Philadelphia, we're oversaturated right now with new product online. They're giving away a large amount of concessions in almost every single format, including single family that's been sitting on the market for too many days. So private owners is single family in my mind.
So even on the single family rental side, there's like a month's free rent.
If they have a savvy enough realtor that understands the marketplace, they're throwing that in, or they're just reducing rent. But regardless, we're looking at least 90 days on market for single families, since probably started really hardcore in October, but we started seeing a huge slowdown in July. Yes.
I agree. That's going to be pretty in sync with what we're going to show. Anybody else want to chime in and add anything? Okay. All right, yeah, and feel free to just stop and ask questions at any time as well. All right, so when we're thinking about the big picture demographic trends that are affecting the apartment market, I think this is one of the most interesting slides, right? And what we're going to do is we're going to go back in time, right, 10 years ago, because we know we've had a really good run in the apartment market for most of the past 5 or 10 years, right? And this chart helps us understand what caused that, right? So if we zoom back in time 10 years ago, so 2008, and we look at the breakdown of Philly's population by age, one of the important things that you're going to see here is that we had a very large group of people in their late teens during that period, right? And that was a positive signal for the apartment market, because what it meant was that, you know, when you turn 20, 21, you typically go off and form your own household, and most of the time you're going to be prone to renting because you can't buy right away. So this was a sign that we had a large number of people coming into the apartment market, and new renter households were going to get formed in the years that followed, right? Now what we're going to do is we're going to zoom ahead in time, right? And you're going to see this age group age forward 10 years to where we are today, the most recent census in 2017. And right now it's a different situation, where by far the biggest age group that we have in our population is people in their late 20s and now getting to early 30s. This is already about a year and a half old. The new census doesn't come out for 2018 for another year. So this is a big question in terms of how is this going to affect the apartment market? Because typically when you enter your 30s, you know, your housing preferences can change in a pretty significant way, right? You're partnering up more often, maybe even having kids. And, you know, when you're 22, your biggest concern about picking an apartment is, you know, I want to be close to my job. I want to be close to the bar. I don't really care how big my apartment is or what the crime situation is maybe like around there or the schools. That stuff's not as important to me, right? But then as this large group of millennials starts getting into their early 30s, things change, right? The crime around the area becomes more important. People are looking for bigger units, so that means lower price per square foot, and they're more concerned with things like schools, et cetera. And I don't know if you've seen that Allstate commercial that's been, you know, it's been playing on a lot of the football games and everything recently, but it's about a guy named Tom Pritchard, and all of his friends are complaining that ever since he bought a house, he just acts exactly like his dad. And so here he's standing in line at the club wearing a windbreaker and a tucked-in flannel shirt. And so the idea is his preference, his lifestyle, and his preferences totally change, right? So Allstate, for example, sees this shift happening, and this is them trying to market to that demographic, right? So Tom Pritchard is a risk to the apartment market for sure. So given all that, you'd expect to see a pretty significant slowdown. But that's not exactly what we're seeing. So rent growth has actually kicked back up in most of these suburbs over the past year. So this is looking at Chester County. You can see just above 3%. Delaware County pushing above 3% year over year in the past few months. Montgomery County accelerating a bit as well. This is the concessions rate in the Philadelphia metro as a whole, and it's not a huge positive in the sense that it's already elevated. So this is the number of available units that are offering 1 month's free rent, right? And we get this through secret shoppers that call and pose as renters. And the bad news is that it's still elevated, but it appears to at least have leveled off. So that's a positive. So what's causing that? Just we have this large demographic that's potentially shifting out of the renter pool into home ownership, and yet fundamentals in the apartment market still seem to be pretty strong, right? Rent growth is still solid, and concessions, while they're high, they're at least not continuing to go up as rapidly as they were a year or two ago, right? So a big part of that is that we're just not building the housing inventory for these millennials to expand into, right? So this is looking at single-family construction in the Philly area, and you can see that permitting is less than half of what it was during the housing boom just 5 or 10 years ago, right? Yep.
I don't know, are you going to touch on the boomers at all? On your previous slide, when you have the millennials singled out, it's surprising to me that the boomers appear to be, if they're in the 65 to 69 range, would that be more or less appropriate, what the boomers are? That it's such a small relative amount of home stock in the population in the area.
I think the boomers, I mean, technically that would stretch back.
Or have they all moved to Florida?
Yes, some of them are, but when you see the big glut in that generation is in terms of numbers, it's still folks that are in their 50s and early 60s, at least in Philadelphia, right? So, and that could be a sign that for sale inventory is going to open up as these folks have to increasingly downsize, and change.
Really in the 50s?
Yeah, 53 to 70.
Yeah.
So it's a 2-year generation, or 20 years.
Yeah, it's kind of a massive.
60s in the 70s.
And this chart is based off of, this is your rental chart, right? This is the chart that you're saying is the.
I think this is just a census here.
No, this is just the population overall in each one of these age groups.
I was just surprised that 65, 60 kind of range is so small.
A lot of the boomers moved to the suburbs anyhow. Some of them are moving back now.
Right, but it's a Philly metro, so that is the suburbs.
But there's not enough inventory for the boomer to age in place either. So everything that's being built is being built towards the millennial for the last decade, give or take 5 to 7 years, and it's not giving the boomer an opportunity to move back into the city. It's not enough space. It doesn't create what they want.
I agree with that.
That's the other half of the problem with.
I was just surprised
right now.
with the sharp drop in the amount of people 65 to 69 considering.
You're looking at the T small ratio. You've got to look at that 54 top end of 54 to 74 this year. Yeah. So the boomers this year 19 is 54, as young as and as old as 74. But that's the issue with the single family too. There isn't a boomer single family being built. So
right, exactly. And then you also have to keep in mind that, look at what has happened to home prices over the past 5 or 10 years in the Philly area, right? So it's not really economical for them to take a mortgage that they're going off of a payment that was made on a home price, 15 years ago and buy into the new market. So that's causing them to stay in place.
But on the other hand, there's a huge active adult construction market going on.
Absolutely, and that's one of the biggest opportunities in the real estate market across the whole country over the next 10 or 20 years because of the large population of folks aging.
Your discussion is sort of ignoring the fact that there appears to have been some structural change in the marketplace, and the fact that millennials are less predisposed to owning You know,
That's not true.
Yeah. Yeah.
what makes you say that?
If you look at the surveys done, millennials actually value home ownership. They're just holding out they don't want the starter home, they want the forever home. So they're willing to hold out for the forever home, and they value more quality. So they're basically waiting to buy something that they can stay in.
Yeah, and that's the point. They're waiting. They're
They're
not
also
buying.
slammed by the student debt.
Yeah, and they're slammed by student debt. So, you know,
Yeah.
their values are definitely different, and that is, you know, that constitutes a structural change. And they also are making babies at a far lower rate, so they have, you know, less reason to want a single family.
Exactly, and that I think is part of the reason that you're seeing. So remember when we started off in the beginning and we're showing rent growth accelerating across different counties? That I think is part of the reason for that is that they're not transitioning into the ownership pool as fast as folks would hope. Although when you survey them, they definitely do have the intention and the aspiration to do it at the same rates as folks older than they are.
Yeah, but
And
intentions are not the same as action.
true,
In
yeah.
the city of Philadelphia, you need $30,000 in cash to come to the table to close on a $350,000 home with 3 to 5% down. So go back to your debt ratio, you're paying off school debt, it's gonna be a 35-year-old who's gonna accumulate $30,000 in cash to sit on unless a parent is helping. And that's the house that they're buying, is a $350,000 minimum house because they want, my clients bought $450,000 for the faucet over the stove that they want in their house and not have to put it in as first-time millennial buyers. So that's the mentality, and that's a lot of cash. With 2.5% tax transfer fee in the city of Philadelphia, yeah, they are waiting longer because they have to with debt and they have to with what they want. So
And
What is tax abatement? I mean,
you still need it to settle, man. It's still 2.5% plus your 3% plus all your other fees.
do you
So
focus on Philadelphia?
yes. Yes, and so the bottom line is the tax abatement is only on their monthly mortgage. It has nothing to do with when they come to the table.
if anything, it makes the purchase price more expensive. Yeah. So because folks are paying for that savings on the monthly payment up front, basically.
So even at 20 years old, when 20 years ago or 30 years ago, someone didn't have to bring that much cash. So it is relevant to timing because they're making more money, but they have higher debt ratio. So unless they're getting married and they had a great wedding, I mean, I'm baffled every day that I'm at a settlement table like, and we're telling my clients, sorry, you need this much cash, you know, cash, I can't find you in any other way. Like at a minimum, it's a $30,000 deal. And that's just a lot for the average American.
Why is there not a preponderance of FHA with assists and that kind of stuff?
But that is what this is. The higher you go at 375, at 400, I'm giving you an assist, I'm paying 3% down. FHA is only 375. I mean, and those aren't the average houses that people are buying these days. It's not the marketplace, at least that I'm working in the center city, Philadelphia area, Fishtown, Brewery Town, $400,000 homes in areas that we wouldn't even be thinking about 5 years ago.
Exactly.
Yeah, they're already assist, but it's only up to 3%.
And in addition to the constraints that they face on their side, they also have the constraint, which is that the for sale inventory, partly because of what we were talking about before with the baby boomers aging in place.
From 55 to 73. That's the issue.
All right. And so this comes from Drexel Center for Urban Innovation. And what you can see here is that the number of homes listed for sale is as low as it's ever been since they started tracking them. And that's for the entire Philadelphia metro area. But then this is just looking at the suburbs, and you can, chart doesn't go as far back, but you can still see that the homes that they actually have to choose from are getting fewer and fewer and fewer. So folks are getting locked into the rental market for longer than they maybe anticipated or maybe than they would wish. So the takeaways, well, this is one takeaway. We're not done with the apartment sector yet, but when you have healthy wage growth happening and limited for sale housing inventory, that's likely going to support continued healthy rent growth in the apartment market over the next year. On the construction side, there's some really interesting things happening as well. So Philadelphia actually has, for specialized construction labor, so like here we're using steel and precast concrete workers, for example, Philly has the second highest wages for that job category of any city in the country. Only New York is more expensive. Do they earn more money? That's Philadelphia County, but if you look, if Montgomery County would be over, it's round about 80,000. So it's still above some of these other county, San Francisco County, Boston, that's Suffolk County, King County, et cetera. So this is a really challenging dynamic if you're a developer, because the thing is, look, building costs or labor costs for this specialized labor is well above all of these other top coastal markets. And our rents for new construction here are only about $3 a square foot on average. Most of these other places, new construction apartment properties can command $5 or $6 a square foot, right? So that creates a really challenging economic environment when the rents that you can charge are only so high, but your construction costs are extremely elevated, right? So what that's doing is it's creating an interesting dynamic where if you look at under construction levels for properties with under 5 stories, those actually continue to tick up. And that's because you need less specialized labor and less steel to get those projects done. Whereas if you look at high-rise projects where the labor becomes more expensive, that's already kind of peaked and is slowly declining. So given that most construction in the suburbs is low-rise, that's not really causing construction to slow all that much here. So this is looking at construction levels across Chester, Delaware, and Montgomery County, and you can see it's near as high as it's been this entire cycle, which is essentially a 30 or 40-year high, right? Yep.
What are you seeing with rental absorption in the suburbs? Because I just can't imagine that you're going to be able to continue building at the rate that you have been for rentals and be able to rent it.
Absolutely. So we're going to show how that kind of plays out in the next couple slides in terms of performance. But I mean, we all know that most of this construction is operating at an extremely high rent level in terms of what they're charging. So here are some projects. We brought these out when I was here in August or September, and I updated these, and guess what? They've all gone up a little bit since that time, right? But the point is, we're talking $1,800 or even over $2,000 for a 2-bedroom, right? And this makes sense because, again, the cost of building this stuff is very high, so they have to stretch for the highest income renter they can possibly get in order to cover those construction costs. Yep.
Do you have any statistics on whether new buildings are cash flow positive or negative in the market?
We're not getting that deep down into a specific building's financials, but what we can see is the occupancy rate over time. So we're calling all of these buildings once a month at least when they're in stabilization, so we could see which ones are leasing up faster and which ones are leasing slower.
What's your impression of stabilization?
Well, it really depends on which submarket you're in. I could talk better in terms of different places and where lease up is happening faster versus slower, and we'll get into that in the next few slides. But so we have all this new product coming on at a very high rent level, and what you can see is that this is the average rent that different renter households are paying across the Philadelphia suburbs, right? And it really drops off once you get above sort of 12 or 1300. So most renters are operating in the lower spectrum of the rental market, right? And so we see how that saturation at the high end has really already started to play out, right? So this is looking at 4- and 5-star properties in the lower main line. So this is, some of the priciest suburban inventory that's being built, right? with swimming pools, fitness centers, etc. And what you can see is that their asking rents, they've already started to lower them in the aggregate going into 2019, right? So these are properties that generally look like this. That's not actually a Philly property. I didn't want to put, that's not a good way to make friends. It shows someone's specific building. On the flip side of that, when you look at the mid to lower tier of the rental market, it's a very different story, right? So now these are 2 or 3-star buildings in Upper Montgomery County, right? So these don't have fitness centers or swimming pools for the most part. They're built in the 70s and they're operating at a significantly lower rent level. No one's building any more of this type of product because it's really not economical to do that. So what you have is a large number of renters in the mid to lower sphere of the rental market who are competing over a limited number of existing affordable rental options, right? So in these type of properties, you continue to see healthy rent growth going into this year. And a big part of that is, again, the accelerated wage growth from the good job market that we're seeing. So with wage growth likely to remain strong over the next year and construction still very elevated, this dynamic is likely going to continue throughout this next coming year in the market. In terms of lease-up rates, it's anywhere that you've seen construction continue to hit in a significant way for 3 or 4 years now. In the suburbs is where you're seeing a slower rate of lease-up, like in the Lower Main Line, for example. There's pockets of vacancy that are hanging around longer than they probably should have. The one exception to that would be King of Prussia. That we really haven't seen a significant slowdown in lease-up or vacancy among new buildings there. And their concessions, everybody's offering concessions, but they're not offering particularly higher concessions than anyone anywhere else, despite all the new product that's come online there. So that is one pocket of the market that continues to hold up relatively well, despite all of this new product coming to market. And the reason for that is that it's a huge office node that historically that's all there was there for the most part, other than single-family housing around. And so they're building rental inventory into a market where there are already high-income jobs, and there just wasn't there was hardly any options for high-end renters for decades. And so they're building into some pent-up demand, and there hasn't been a slowdown there. But other pockets in Center City, Lower Main Line, that's where you started to see these declining rents and accelerating concessions really start coming into play. And speaking of that, these are the 3 largest projects that are going to come online in the Philly suburbs this year. The one that I think is particularly interesting that I wanted to highlight is Station at Willow Grove. It's well along the way. It's delivering right a block away from the Willow Grove Regional Rail Station. And what's interesting about that is that shows how developers, competition is getting pretty intense in some of these areas where building has been happening for 3 or 4 years. But this part of Willow Grove hasn't seen apartment construction since the 1970s, not large-scale apartment construction at least. So this is kind of indicative of how they're branching out and going in and trying to test locations where they don't have as much competition from other developers. So the takeaways the final takeaways for the apartment market here is that rent growth is likely to be strongest amongst more affordable, older apartment communities with more modest amenity offerings, whereas luxury communities could see rent declines in some markets where new units have been delivering for years. All right, getting into the office market. We'd like to open it up if anybody has any thoughts on office leasing or anything they see going on in the market so far this year. All right, so with the apartment market, the way we did it is we talked about all the risks that were out there first, and then we explained why most pockets of the apartment market are still doing relatively well. Office, we're kind of going to do the opposite. We're going to talk about some of the strongest things that we see in the market right now, but also some signs that are pretty indicative of weakness out there too. So on the positive side, this recovery has been going on for almost 10 years, And with little new construction, vacancies have been going down that whole time. So the office vacancy rate is about as tight as it's been in 20 years, which is a positive. Rent growth, as we're going into the new year, pretty consistent with where it's been in the range. So in the Philadelphia suburbs, and when I say Philadelphia's PA suburbs, I'm talking about the Pennsylvania areas, so Bucks County, Montgomery County, Chester County, Delaware County. Rent growth pretty consistent in that 2.5% range where it's been bobbing around for the past few years, and Center City more in the 3.5% to 4% range. Right, so those are the positives. Start pulling under the surface of the office market, and you start to see a little more indications of weakness, right? So this is looking at total occupied space and how much has it grown in Philly suburbs versus Center City versus the U.S. average since 2008. And you can see that big jump, that's Comcast moving into the new tower, right? But without that, Center City's growing pretty slow, and the Philadelphia suburbs are lagging the U.S. average as well. And so why is that, right? Well, the big picture is for an office market, as a city, there's two things that you can really have to drive in a lot of new tenants and tenant expansions and tons of new white-collar businesses that really lead to a lot of demand in the office market, right? So one thing you can do is you can dramatically lower your business costs, right? So that's what cities like Atlanta and Dallas do. It's kind of an oversimplification, but their economic development departments are literally calling businesses that are located in San Francisco and saying, hey, why don't you guys move here? We'll give you a tax abatement to come. You can pay your employees less because living costs are a third of what they are in San Francisco. Why don't you give it a shot? And they're pretty successful in terms of luring corporate relocations in, right? The other thing you can do is just have a hyper concentration of really skilled workers. Like this is what they have in San Francisco or in Boston, where companies say, listen, if I want the top people in the pharmaceutical industry or in IT programming, I'd rather be somewhere else that's cheaper, but I really can't get it anywhere else. So I have to be nearby Stanford. I have to be near MIT, right? And so low taxes or extremely high educational attainment, that's what pulls companies, white-collar companies in. And Philly's kind of in the middle on both of those. It doesn't really stand out on either one of those measures. So it's rare that you hear of a new company moving into Philadelphia. And that's the reason why absorption trails the U.S. average over the long term, right? When you look at absorption, it's in the suburbs, it's been slowing down over the past 12 months. And this is really interesting. So from all the lease availabilities that we track, we can look at the volume of space that's listed as available onto the market. And that's been ticking up in the past few quarters recently as well. And so why is that happening, right? Especially with a huge tax cut going into the corporate sector, that's not necessarily what you'd want to see given that. A big reason for that is that we see very little new office construction in Philadelphia at all. So this is looking at office construction as a percentage of the market in Philly and the other top 10 or 15 major markets. And you can see that we're at the very bottom of the list in terms of construction now with Minneapolis. So why is that?
As you drive around Philly, you see all that new skyline that pales in comparison to other cities.
Definitely, yeah. So when
University City, Market Street, it's just
absolutely. I mean, if you look at like for example in Boston, they've built an entire new node to their financial district in the Seaport. In New York, their Midtown West is entirely multiple 1.5 million square feet. And then you have places like Dallas and Houston that are just growing like gangbusters all the time. So we're pretty far behind. And the reason for that is that rent growth hasn't necessarily kept up with construction costs, which we talked about earlier. So it makes it not necessarily economical to build new office. So that's kind of now we're contrasting it with a market like San Francisco, and you can see their rents are extremely volatile, but over the long term, they are keeping pace with construction, and that's why construction costs, and that's why you're seeing more and more building, right? And we can see how this affects Philly. So this orange layer, that's office construction in Philly over time. So as that gap between construction costs and rents gets wider and wider over time, you see the volume of office construction going down, right? So what are the implications of that, right? It means that the office inventory that we have here is pretty dated. So this is looking at the percentage of properties that are more than 30 years old in the market. And you can see that that percentage is as high as it's been since coming out of World War II and the Great Depression, right? So it's pretty, so the inventory is getting old. Now this does create some opportunities for people. So this is the rent premium that newly renovated properties are commanding over the market average, right? And that's at an all-time high because with the inventory being relatively dated, there's a high demand for fresh new space, like this building that we're in right now. And these are just some examples of that opportunity that comes out of that aging inventory. So these are some major renovations of older, outdated properties that have happened over the past year or two. And the leasing environment for these buildings has been strong. 500 North Gulf Road is right around the corner from here. You can see it was a vacant, 70s building that was sitting empty for a very long time, and finally landed CSL Bearing and has done a complete gut renovation to the point it looks almost like a modern new space. And you see a lot of other examples like this throughout the market. So even though the leasing market may be relatively weak in the aggregate, for the fresh new space that can make its way to market one way or another, it's relatively strong. The other thing that's weighing on the market in a big way is that because the inventory is older, what that means is that when a major publicly traded company goes to make a new expansion and they look out at their options, they don't necessarily like what they see, right? And so in many, many instances, they're choosing to, rather than move into an existing building and fill up some of the competition that's out there on the market, they're choosing to just build their own campus, which becomes easier now that they're flush with cash, like we were talking about before, right? So this has been happening throughout the whole cycle, but there's definitely been an acceleration over the past year post-tax cut with these companies having a lot more money to spend, and that's when you heard Amerisource Burgeon leasing Sora West and Conshohocken, and AmeriHealth Caritas also is moving some people out of the airport area to move to a new campus all the way in Newtown Square, right? So it's somewhat of a drag on the market when you have your companies that are expanding the fastest opting to just go and build new space rather than move into existing space that's competing out there on the market. And then there's also the densification trend of companies trying to fit more workers in less space, right? And this happens, it plays out in different ways. Like this is the shiny example of new age co-working space that looks very appealing when you're just looking at the picture, but the reality is there's a lot of people here crammed into a very small space. And then there's kind of the more modest picture like what you see here. So this is a common thing that companies across the country and definitely here are doing to economize the amount of office square footage that they lease, right? So here's some examples of how that's playing out. Like Toll Brothers, for example, has been at their office in Horsham for at least 5 or 10 years. And their lease is up in mid-2019. And what they're doing is they're moving into a much more modern space, but they're fitting all of their workers in a smaller footprint. You also saw Wells Fargo announce something like that downtown, although they're also just taking a lot of workers and shifting them to North Carolina and lower cost destinations as well. But the bottom line is when their lease comes up for expiration, they're taking a smaller space. And then Exelon Generation, this is a company that owns Pico, they have a big lease that's expiring in 2020 in Newtown Square. So, and they're known to be looking for a significantly smaller space than the one that they occupy now. So some takeaways for the office market is that it's likely to remain tight in 2019, but some of the weakening in the leasing market, especially for existing properties, it's pretty concerning because when you see that trend happening now at a time when companies are experiencing a windfall in corporate profits, it's somewhat of an indicator of what things could be like in the future when that benefit is no longer there, right? However, big tenants, the amount of fresh, newly renovated or newly built space is very limited and very sought after right now. So for those properties, you can expect the leasing market to still be strong over the next year. All right, the industrial market, and this is a pretty exciting market. This is the most booming property sector that we have in Philadelphia now. And what you hear when folks talking about what's driving that strength in the industrial market, it's all about the fact that with online shopping on the rise, retail goods are spending a lot more time in the warehouse and a lot less time on the store shelves as e-commerce orders get fulfilled and delivered. So that's driving warehouse demand. And the best way that you can see that play out is in the employment data. So this chart is looking at the growth in transport and warehousing employment in the Philly area versus retail trade, right? And you can see that they're going in the complete opposite direction. And part of that too is automated checkout as well. But the most interesting thing is that you've seen this transportation and warehouse employment really explode, and it wasn't happening this whole cycle. It really started to kick in 2015, and it took off from there. And that's corresponded with a really sharp drop in industrial vacancy rates that happened around that exact same time. So they're now at all-time lows, the lowest we've ever seen on record in Philadelphia. And what's driving that? So these are all Amazon locations. And when you look at the ones on this chart that are just in the Philadelphia area, all of them were opened post 2014, except for one. So they're mainly opting for newly delivered high-end warehouses all throughout New Jersey. So the high end of the market is really just completely spoken for in the sense that there's hardly any availability whatsoever. Yeah.
Are they building their own, or are they leasing?
There's merchant developers that are making a lot of money building and then leasing and then selling to an institutional real estate owner. So for the most part, no, they're not buying. They're going in on a 10 or 15-year lease. Yeah. But so that's Amazon and Jet.com and some of these big online retailers are really the ones moving the market in a big way. But along with that, they also have smaller third-party distributors, and it's forcing folks who might otherwise locate in bigger spaces to go down a notch in terms of property quality and look at properties that in a market that wasn't so tight, they might not be looking at. So these are all 50,000 square foot industrial leases that have been signed just over the past 3 years in Philly, and you can see they're pretty abundant. These are all the largest major leases in that group, and these are just tenants that are leasing existing space. So not the newly delivered stuff that doesn't really impact the vacancy rate in the market, but just moving into existing buildings. And you can see that the third-party logistics companies who do a lot of fast delivery for online retail, for people selling goods online, they're making up a big category, but it's really across the board in terms of all types of industrial businesses. And when you look at our rent growth, we were lagging the U.S. average for most of this cycle, but as Amazon and these e-commerce retailers have really started to focus on expanding in the Mid-Atlantic in a big way, our rent growth has actually accelerated above the U.S. average. So one thing that's causing is more and more anecdotes of developers breaking ground on speculative projects, so projects that are not leased, and that's definitely ticking up in Philly. But the demand is likely, as long as the economy continues to grow, the demand for that space is likely going to be there. So why is that? Well, this is just looking at e-commerce sales as a percentage of total U.S. retail sales, and you can see it remains on an upward track, right? Everybody knows that. But the interesting thing is like how our e-commerce, how widespread e-commerce is here versus in other countries. It's actually significantly more popular and more used in China, for example, or in parts of Europe like the UK. So I have a friend in China who was telling me about this, that first of all, almost everything you order can be delivered within one day. And the delivery costs are significantly lower. So this incentivizes households to buy even cheaper things, just like more toothbrushes and paper towels and all of that. The concept, Amazon is now, setting up operations in Whole Foods, and they're providing these pickup points for you to drop off or pick up packages as you just go about your normal day. Like in China, for example, that's already extremely common, not just among big businesses, but small businesses provide that service for you to pick things up as well. And almost every major product that you'll buy on a Chinese e-commerce website, for example, has a video of user review videos, which are things that we don't have. And the algorithms are supposedly much better at matching you up with things that you need. So there are already countries that are pushing the e-commerce delivery platform much more so than we are today, and likely we're just going to continue down that road over the long term. So if a recession were to happen, you might see a pause in all of these companies that are expanding, but overall there's a lot more runway for this to continue. So the takeaway there is really that continued shift to online shopping and really healthy consumers as well is likely to keep the industrial market extremely tight going into this year. All right, that's everything we got. I know we had a lot of questions throughout, but if anybody has any additional ones, feel free to bring them up. Yep.
So what about 2020?
Right.
Do you think, well, like another economist the other day said, sort of indicated that there would be a recession, but it won't be a deep recession for real estate, for commercial.
Right. Yeah, that's becoming more and more the consensus view among economists, 2020, 2021. I mean, the reality is you can really only tell whether a recession is coming if it's 6 to 12 months out. Beyond that, folks don't really know. They're guessing, but they're increasingly gravitating around that idea because of rising rates mostly and trade concerns. But I think that point that you mentioned about the real estate recession being more mild is probably correct, because you're not seeing the wave of speculative construction that you normally see across most property types this late in the cycle. So if a downturn were to happen, you wouldn't have that huge overhang of new deliveries that are competing to lease up like you did in 2006 or in the 1990s. Yeah.
On the corporate level, I've been doing a lot of readings, and on the corporate level, so the interest rate's really low over the last 10 years, going lower. They've loaded up with a lot of corporate debt to the point where some of the corporations cannot pay it back. What this means overall is that if you were to look at the bond ratings for the different corporations, I don't know if you do that, but as the bond ratings drop to jump, which they have for a lot of significant corporations because they can't possibly pay these loans back, even with profit. Have you gone into that facet of it? Have you seen that for a long-range plan at all, or immediate red flags, you might say?
Right. The corporate debt that's been taken on is obviously, that's a big risk factor when people talk about different what could potentially cause a downturn. But I guess the thing that I would emphasize about that is that if companies can't sustain, a 10-year the 10-year rate being 5%, then it likely won't get to 5% or it won't stay there for very long. And so because it will then cause growth to slow and interest rates go down. So I think a lot of people they see the interest rate tightening that's happened over the past year, and the dialogue now is all about, oh, rates are going up and what is this going to do? But if you look at the long-term path of what interest rates are doing, they've basically been continuously going further and further down for the past 30 years, since the 1980s. So it's entirely possible that the interest rate hikes that we're seeing right now is just a very temporary phase of a very hot economy. And you're already seeing a lot of people say that they don't think that the Fed will even be able to raise interest rates more than twice next year. And some folks saying they think they'll even actually cut them. So my response to that would be that if corporations really are that levered to the point that rates would cause them serious problems, then that means the economy can't support rates going that high, and they probably won't stay there for very long. And that's a positive for commercial low interest rates is obviously a positive for commercial real estate overall.
Yeah. Where do you sit at CoStar as it pertains to like new developments coming on? You went over some new developments with a lot of apartment places, the big companies that are just going out and building their own campus. From where you sit, how do you see property taxes come into play when those companies, those developers are making their decisions as to what to build and where? How does that play into their plans for going to build, and the taxing authorities, how do they deal with it? Do they see that as big opportunities to
I can't speak to how the developers are kind of modeling that, but what I can say is that, for example, on the apartment side, because valuations are so tight across the apartment market, buyers have really started to pay a lot more attention in terms of making sure they underwrite how taxes are going to be reassessed after they make that purchase. And across shops, we've heard people saying that they're expecting big increases in property taxes, after year one that they buy their properties, and that the reason they're focused on that is because if they miscalculate that can impact the financials of their entire deal because it's so aggressively underwritten. So I'm sure that the developers are also, keeping their eye on that as well in terms of how it could affect financials. Yeah. Yep.
You see a lot of municipalities looking to increase their earned income tax, like Westchester recently did. Earned income tax rate.
Being focused on the Philadelphia area, I haven't seen that. All the dialogue over the past year was about the construction tax, as you know. Yeah. All right. Well, thank you, everyone. I look forward to doing this again.
And as I mentioned again, we are recording today's session, so we'll send out a link to that. And you're okay with sharing the PDF of the slides as well?
Sure. Yeah.
Okay, and we'll send that out directly to you all as well. So thanks for coming today, and we'll hope to see you at another commercial chapter event in the near future. Thank you, everybody. Thank you. Thanks, Adrian. Great job. Stop that.